The topic for today is NBFC. Let's see in detail what does this mean. First of all, we will consider the definition. See, a non-banking financial company, which is NBFC, it's a company registered under the Companies Act 2013. So it goes very easy that it is a company properly registered under 2013 Companies Act. NBFCs are the financial institutions that offer various banking services but don't have banking license. These institutions are not allowed to take traditional demand deposits. So they are like banks, but they are not actually banks. They don't have banking license with them, but they offer certain banking services. But they cannot take traditionally what banks do, take on the demand deposits. They cannot take those demand deposits. This is basically what NBFC is. A non-banking institution, which is a company and has principal business of receiving deposits under any scheme or arrangement in one lump sum or in installments by way of contributions or in any other manner, is also a non-banking financial company, which is, we call it residuary non-banking company. See, if it is an institution, here we talked about the company. NBFC is a company. If you come across a certain institution which is a non-banking one, but the business is to receive deposits, it could be under any of the schemes. You have so many schemes, or it can be one lump sum amount you take, and it can be in installments also, in which in these deposits you contribute in any manner, whether it is in one scheme, whether it is lump sum scheme or in installment scheme, that also will be considered a non-banking financial company. This we call residuary non-banking company. Further, these NBFCs are engaged in the business of loans and advances. So the basic purpose of NBFCs are, they will be giving you definitely loans and advances you can have from NBFCs. They also deal in the acquisition of shares, stocks, bonds, debentures, and securities. So this is their basic job. Either they give the loans and advances, or they deal with shares, stocks, bonds, debentures, and securities, which are issued maybe by the government or by the local authority or any other marketable securities as well. So whosoever is issuing all these 5 types of commodities, they can deal with them, right? Or of a like nature, something like leasing, hire purchase, insurance business, and chit business. They also deal with these businesses. So if we segregate their function, it is loans and advances, A. Secondly, they deal with share, stocks, debentures, and securities and bonds. They can be issued by the government or local authority, no problem. And of course, they also deal with leasing, hire purchase, insurance, and chit business. This is what NBFC does. Now listen, it does not include any institution whose principal business is that of agricultural activity. You are dealing in agriculture activity, you are not our NBFCs. You are dealing in an industrial activity, no, you are also out of the context. Purchase or sale of any goods other than securities. So for them, the goods is these securities. They deal in these things. If you are dealing in anything else other than securities, you are not an NBFC. Or providing any services and sale, purchase, construction of immovable property, you are also not an NBFC. I repeat, engaged in agricultural activity, no. Industrial activity, no. Only securities. Other than securities, you're dealing in any other goods, you are not NBFCs. And of course, if you are in the purchase, construction of immovable property, you are also not NBFCs. Next, now NBFCs and banks, let's consider what is the difference between them. NBFCs lend and make investments, as we saw in the previous slide. They also make advances as loans, and hence their activities are akin to that of banks. Something similar to banks is what they do. However, there are a few differences. Let's see. They cannot accept demand deposits. So NBFCs, the first rule is that you cannot. Only the banks are authorized to accept the demand deposits. Secondly, NBFCs do not form part of the payment and settlement system. and cannot issue checks drawn on itself. So again, this payment and settlement system, issuing of checks, it is just exclusively can be done by the banks. Third point, deposit insurance facility. This deposit insurance facility is also out of the context of NBFC. Deposit Insurance and Credit Guarantee Corporation. Under this heading, it's not available to the depositors of NBFC, unlike in case of banks. So this facility is also just exclusively for banks. Further, now what are the types of NBFCs? Different categories of NBFCs are registered with RBIs. They are as follows. Now, on what basis do we actually categorize them? It is by the kind of activity they conduct. We'll discuss it. In the terms of type of liabilities into deposit and non-deposit accepting NBCs, like what type of liabilities do you deal with that? And the third is non-deposit taking NBFCs by their size into systematically important and other non-deposit holding companies. All these points will be discussed in detail in the coming slides. Now, the first category was NBFC as per the nature of activity. See, first is Asset Finance Company, which we call AFC. What is it? AFC is a company which is a financial institution carrying on as its principal business the financing of physical assets. So, it will finance only physical assets. AFC will be giving you finance for physical assets supporting productive or economic activity such as automobiles, tractors, lathe machines, generator sets, earth moving, material handling equipment, moving on own power, general purpose industrial machine. So if you want a loan to finance anything like this, you can approach an NBFC, and that type of NBFC which finances the physical assets is called AFC. Now these physical assets have to be a part of economic mainstream. Obviously, the person who is taking loan for these physical assets has to earn the livelihood from these assets. That is why he is approaching the NBFC, of course. So these AFCs, they will finance the physical assets to come in the economic mainstream, anything for industrial machines or generator sets or automobiles. Now, the principal business for this purpose is defined as aggregate of financing real or physical assets supporting economic activity. Obviously, if you are going to take a loan from AFC for any physical asset, you have to earn livelihood, you have to earn money from that, only that cause you have approached AFC to finance your machine. And income arising therefrom is not less than 60% of its total assets and total income respectively. So this extra clause has been added that AFC will be the one whose income arising from these financing physical assets is not less than. It can be more than, but at least the minimum bar is 60% of its total assets and total income respectively. AFC's income should not be less than 60% of its total assets and income respectively. Clear? Further, investment company IC. IC means any company which is a financial institution carrying on as its principal business the acquisition of securities. So just we saw that AFC finances the machines. Investment company, acquisition of securities. It deals only in securities. These include primary dealers who deal in underwriting and market making for government securities. So they can be indulged in underwriting of the government securities. So the main business is the securities. That is called IC. Next is the loan company LC. LC means any company which is a financial institution carrying on its principal business the providing of finance. Right? It has to provide finance whether by making loans and advances or otherwise for any activity other than its own but does not include an asset finance company. So it is indulged, it will be financing loans and advances, right? But not for the physical assets. If you are taking a loan, if it is giving a loan for the physical asset, no, that is the work of AFC. It will be financing, no doubt, advances and loans for any other activity, but not for physical assets. Clear? Further, Now, under the circular on harmonization of the non-banking financial company categories, RBI merged 3 different categories of NBFCs. Asset finance companies, loan companies and investment companies, all the 3 we just discussed, into one name. So these were culminated to one name, NBFC Investment and Credit Company, NBFC-ICC. Very simple. Now what is this? Financial institution carrying on its principal business, asset financing, providing of finance, whether by making loans or advances or otherwise, for any activity other than its own, and the acquisition of securities. This is the total of these 3 definitions which we just discussed. The main object of merging 3 categories of NBFCs into one is to provide greater operational flexibility to the NBFC sector. Sometimes when we make one rule for these 3, so it gives them more flexibility. This is what has been done by RBI. Now, in the list, number 4 comes Infrastructure Finance Company. Again, IFC, it's a non-banking finance company which deploys at least 75% of its total assets in infrastructure loans. So it will be advancing infrastructure loans and it has not to be less than 75% of its total assets. Second clause, it has a minimum net owned funds of 300 crore, such a bigger value. And it has a minimum credit rating of A or equivalent. Minimum credit rating A, it can be higher, like we have AA, AAA. And capital to risk weighted asset ratio. This ratios has to be calculated. And here CRAR of 15%, it should have 15%. So these are the 4 clauses for IFC. Fifth is non-banking financial company, IDF NBFC. So, IDF NBFC is a company registered as NBFC to facilitate the flow of long-term debt into infrastructure project. So, you are going to give long-term debts and that have to be in the infrastructure projects. IDF NBFC raised resources through issue of rupee or dollar denominated bonds of minimum 5-year maturity. Very clear. Only infrastructure finance companies, they can sponsor IDF NBFCs. So who can sponsor IDF? Only the IFCs, they can sponsor IDF NBFCs. IDF actually, infrastructure debt fund, they are investment vehicles which can be sponsored by commercial banks and NBFCs in India, which domestic institutional investors, especially insurance and pension funds, can invest through units and bonds issued by IDFCs. Okay, so the 4th we discussed this IFC and 5th is IDF NBFC. 6th point comes microfinance institutions, NBFC-MFI. It is a non-deposit taking NBFC having not less than 85% of its assets in the nature of qualifying assets which satisfy the following criteria. So in the previous we discussed total assets. Here also total not less than 85% has to be in these. Let's discuss what is it. First is loan disbursed by NBFC-MFI to a borrower with a rural household annual income not exceeding 1 lakh or urban and semi-urban household income not exceeding 1,60,000. So the criteria is that if you are issuing a loan to a rural household, the income of that particular household has not to cross 1 lakh. And if it is urban or semi-urban, the income of that household has not to cross 1,60,000. Second point is the loan amount does not exceed 50,000 in the first cycle and 1 lakh in the subsequent cycle. So there is a limit to the loan amount as well. C point, total indebtedness of the borrower does not exceed 1 lakh. The borrower will not go in the debt exceeding 1 lakh rupees. Fourth point, tenure of the loan not to be less than 24 months for the loan amount in excess of 15,000 with prepayment without penalty. So the tenure, it has not to be less than 24 months because they won't give time for the household to repay them back. And in excess of 15,000 with prepayment without penalty. E point, loan to be extended without collateral. You don't have to keep any collateral in this case. Next, aggregate amount of loans given for income generation is not less than 50% of the total loans given by the MFIs. Now, this institution it should not be less than 50%. The total loan which you are giving for income generation not to be less than 50%. Loan is repayable on weekly, fortnightly or monthly installments at the choice of the borrower. So they have made it very simple so that these NBFCs, they can reach to the poorer of the poor. So you can even repay it weekly, fortnightly or monthly installments as it suits the choice of the borrower. Seventh point comes systematically important core investment companies, CIC-ND-SI. This is an NBFC carrying on the business of acquisition of shares and securities which satisfy the following conditions. Now, what are these conditions? Let's see. It holds not less than 90% of its total assets in the form of investment in equity shares, preference shares, debt or loans in group companies. So, at least 90% of its asset has to be in this form. Its investment in the equity shares in group companies constitutes not less than 60% of its total assets. See, here it is 90% and then there is a long list. The investment in equity shares is not to be less than 60% of the total assets. But these equity shares, they include instruments compulsorily convertible into equity shares within a period not exceeding 10 years from the date of issue. So, these compulsory convertible into equity shares, these instruments also include in the term equity shares here. C point, it does not trade in investments in shares, debt or loans in group companies except through block sale for the purpose of dilution or disinvestment. So, the main criteria here, main focus will be its dilution or disinvestment. Otherwise, normal shares, loans, group companies, no, it's not interested. It does not trade in those investments. Further, it does not carry on any other financial activity referred to in section 45, 451C and 451F of the RBI Act 1934 except investment in bank deposits, money market instruments, government securities, loans to and investment in debt issuance of group companies or guarantees issued on the behalf of group companies. So, and this section, this act, these particular sections, it does not deal in any financial activity of these sections. Its asset size is 100 crore or above. This is the clause, and it also accepts public fund. Further, 8th point is factors, NBFC factors. NBFC factor is a non-deposit taking NBFC engaged in the principal business of factoring. Right now, what is a factoring? Factoring means you sell your raised invoices to a factoring company. Supposingly, I am a businessman and I have so many invoices raised, like people have to pay me. But what I will do is, I will sell my invoices to a factor company. Factor company will pay me the bulk of the invoiced amount immediately. Typically, say up to 80 or 90% of the value after verifying that the invoices are valid. Now, my customers will pay directly to the finance company. What advantage did I have from here is I got my immediate cash. I don't have to wait for the bills to mature. Right? So, it provided me with immediate cash. It increases my cash flow. Okay, and give me my resources to pay my expenses and I can deal with more new clients. So this is actually what is factoring is. So the financial assets in the factoring business should constitute at least 75% of its total assets, and its income derived from factoring business should not be less than 75% of the gross income. So what is an NBFC factor? The condition is you have the basic function will be factoring. I told you what factoring is. Now, but the clause is that at least 75% of total assets the business should constitute in factoring business, and of course the income also. The factoring income should not be less than 75% of its total gross income. Factoring is when companies sell their raised invoices to get immediate cash. I have already explained. Now, 9th is mortgage guarantee companies. MGCs are financial institutions for which at least 90% of the business turnover is mortgage guarantee business. So you are mortgaging your items, so that is called mortgaging guarantee business. 90%. or at least 90% of the gross income is from mortgage guarantee business and net owned fund is 100 crore. These two conditions meet, then you come under mortgage guarantee companies, MGCs. Now another way of classification of NBCs as per types of liability and sizes. First is the deposit taking NBFCs. Simple. Those who take deposit. Second is the non-deposit taking NBFCs. They are further classified into. They don't take deposits. A part of this point is systematically important. Now see, NBFCs whose asset side is of 500 crores or more as per the last audited balance sheet are considered systematically important NBFCs. Their asset side has to be minimum 500 crores. The rationale for such classification is that the activities of such NBFCs will have a bearing on the financial stability of the overall economy. They'll play a bigger part in the overall economy. And non-systematic investment NBFC ND with asset size of less than 500 crores. Those assets is less than 500 crores. They are exempted from requirement of maintaining CRAR, we just discussed, capital to risk asset ratio, and complying with credit creation norms. So they are exempted from these two things. The benchmark is 500 crores. Asset size 500 crores. Now we come over methods of financing for purchasing assets. How will you finance it? Either it will be in the form of loans or hire purchasing installments, or it will be leasing. Lease rental is the consideration for the right to use a product. The product is not sold. You must have heard it. What leasing is actually, under you take a say 10-year, 20-year, 50-year lease. So what is that lease? You have the right to use that product, but the product is not sold to you. But for those 50 years, it is yours. Obviously, you can do whatever, but you cannot, it is not deemed to be sold. See, in case of operating lease, the lessor, that is the entity which offers the lease, has the obligation to maintain the product. The one who is leasing out, he has to maintain the product. He has to look the welfare. In case of financial lease, no such obligation of the lessor. He doesn't have to maintain the product. Lessor typically sells the product to the lessee at a residual value at the end of the tenure of the lease contract. Once the lease contract comes to an end, it is deemed that the lessor definitely will sell off the product to the lessee. Now, we will be discussing the difference between financial lease and the operating lease. Meaning, the financial lease is the commercial arrangement in which the lessor allows the lessee to use the asset for maximum part of its economic life against payment of rentals. Is called financial lease. We just determine that what would be the economic life of that particular asset, and for that time you are allowed to use it. A commercial arrangement in which the lessor allows the lessee to use the asset for a term smaller than the economic life of the asset against the payment of rentals. Here it is generally done for its maximum usage life, and here it is leased out for less than the maximum usage life. It is financial lease is a loan agreement, and here it is a rental agreement. Now the lease term for the financial lease is longer as compared to the operating lease. Clear? And here the operating lease term is short. Now risk bearing for obsolescence, it rests with the lessee, and here it rests with the lessor. Further, now cancellation of the lease only on the happening of certain specified event. It will be mentioned in the clause that if this and this happens, then the lease shall be cancelled, and here it can be done. There is no such restriction to that. Now the tax benefits, depreciation and finance charges are allowed as deduction to the lessee. And here lease rent is allowable as a deduction to the lessee. Here only depreciation and finance charges, and here the lease rent. Now cost of repairs and maintenance, they are to be borne by the lessee in this case, and here they are borne by the lessor. Bargain purchase option. The lessee contains an option where the lease contains an option where the lessee can purchase the equipment at the price less than the fair market value, and here no such option is given. Now the transferability of the risk and the rewards from the lessor to the lessee with the transfer of the asset, if it happens. Does not transfer from the lessor to the lessee with the transfer of the asset. It does not transfer. Now loan versus lease versus hire purchase. A very interesting topic comes here. Now, the title or the ownership of the asset. In case of loan, it passes immediately to the borrower. The title passes immediately. And in case of lease, it remains with the lessor, as I just told you. And under hire purchase, transfers to the hirer at the end of the hire purchase contract. After the contract is over, only then it will get transferred. Tax treatment. Interest expenses are tax deductible. In India, home loan principal repayments are also tax deductible. In case of lease, complete lease rentals are tax deductible, and here only interest component is tax deductible, right? Now, upfront payment by the borrower or the hirer or the lessee. Borrower must pay some amount as lender doesn't finance 100%. The borrower has to pay a little amount. Here, lessor may collect 1 or 2 lease rentals upfront. It can collect 1 or 2. Owner may collect 1 or 2 installments upfront, that is allowed. In the installment, now what is the installment payment? Higher, as it is for the full value of the asset. Lease, it is lower the payment for part of the value of the asset. And here hire purchase, it is higher than the lease of the loan, as hire purchase charges are usually higher. Last point here is tax depreciation. It is claimed by the borrower as he is the owner, and it is claimed by the lessor as he is the owner, and it is claimed by the hirer. Though not the owner, ownership passes to him after the expiry of the hire purchase. So here we come to the end of the article. I hope you liked it and you understood the whole topic. Please like and subscribe to my channel. Comment in the comment section if you have any suggestions with this regard. Thanks for watching. Stay safe, stay blessed.